Research shows this is the only way to beat the markets. You don't want to go against research, do you? Of course, I've always chuckled. Why do you want to beat the market? I've never understood that. It's weird to me. People waste so much time and energy and never mind money on trying to beat the market. Man, I beat the market by 20 basis points. Okay, well, the market was down 37% in 2008, and you're only down 36.8%. Hey, gold star for you, buddy. It never made sense. Beat the market. Don't waste your time on this. But research will show us what the only way to beat the market is. And I'm going to share it with you. All right, so we're going to look at this paper from the Swiss Finance Institute. If it's from Switzerland, you can't argue with that. They're European, right? Europeans lead the way. A comprehensive look at empirical performance of equity premium predictions. Number 2. So this guy, I guess, I don't know if these are women, men. I'm not sure what the Switzerland names are, but Amit, Evo, and Athanes, something like that. This is dated September 23rd, 2021. Our paper re-examines whether 29 variables from 26 papers that were published since 2008, as well as the original 17 that were published before that, were useful in predicting the equity premium in sample and out of sample. Our samples include the original periods of which these variables were identified, but ends later in 2020. Most variables have already lost their empirical support, but a handful still remain reasonably well. However, the overall predictive performance remains disappointing. All right, so we're going to talk about variables. Factors, if you will. I was raised under the French Fama three-factor thing, which is dividend investing. High dividend yield, low price to earnings, low price to books. That is a value investment. Now, the reason the high dividend yields because of low price to book and low price to earnings, i.e., the price has fallen off a cliff. That's what happens here. And I did not know that back then. I know it now, and I still understand that is a value stock. You're buying a stock that has been beaten down for some reason. Value stocks are inherently more aggressive or more risky than growth-oriented stocks. I know that seems counterintuitive, but the reason the value stock is value, i.e. low price to book, low price to earnings, high dividend yield, is because it's been beaten down a lot of times because the earnings or the debt levels get out of control. The earnings are falling off a cliff or something like that. And you can buy a value stock, Bethlehem Steel, and watch it go to complete value, which is zero. All right, so value stocks are inherently more risky because they've been beaten down so much. And so you get more upside when they actually rise from the ashes. What's GE doing right now? The last I checked, GE was coming back from the ashes of the ash heap of history. I haven't checked for a while, so let's see old GE here. But that would be a perfect example of a value stock that got smoked and has come back. GE. Yeah, oh man, yeah, perfect. Oh, that's crazy. Is that GE? They must have done yeah, okay. So there's GE. They must have done a split or a reverse. They must have a share buyback. They must have done a reverse split or share buyback because there they are. That's GE. It's trading at 65, and not that long ago it was trading like at 7. So they've done something to keep it listed. I'm not sure what they've done actually, but okay. So I saw it trade at 65. I said, damn, because I remember when it was trading at 7. They did a reverse buyback of some sort. Yeah, but they got no price to earnings ratio. Their dividend yield is less than 1%. It's a value stock that's getting hammered. But it could come back. I don't know. We'll see. Actually, just real quick. Yeah, I mean, it did kind of have a. Yeah, still no. It doesn't look. I mean, that's GE, man. Look at that. All right. Anyway, so that would be a value stock. Amazon, on the other hand, would be a growth stock, and the growth stock on Amazon, the PE is going to be 106. It doesn't have any dividend. But you'd say, I want to buy Amazon because of growth opportunities. I want to buy GE. I don't even know if I'd qualify GE anymore as a value stock because it got no PE ratio. It has a dividend yield of 0.49. I don't know. Anyway, the point being is I was raised on the French Fama. Low price to book, low price to earnings, high dividend yield. That's a value stock. All right, I can't get that on my, it's in my blood, man. All right. Now, what happened with the French Fama model, the dividend growth and all that, is that became, it's kind of like the dogs of the Dow. Yesterday's news. It worked until it didn't. And that's what these are analyzing. They're analyzing other variables of factor model that say, oh, these worked for a certain amount of time, but then they don't. You see what I'm saying? So let's go into this right here. A large number of papers predicting the equity premium have basically the ability to beat the market have been published by top finance journals. It seems that academic finance has conquered the problem of investors predicting time-varying future rates of return. Many of these papers have offered strong theoretical foundations for their variables, presumably increasing faith in their forward-looking stability from looking backwards. In this paper, we examined 29 variables for which we could relatively easily reconstruct the predictive variable. The data in these papers ended between 2000 and 2017. We can replicate and confirm the principal in-sample findings for all but 2 of the papers. So basically, we can replicate what they've done and see if it works. 2 of them, the data had issues. We can then extend the samples by a few years, ending in December 2020. Typically, an extra 10 years of data. So not only we're going to look at the pre-selected years, which make things look good, we're going to extend it until 2020. Because our paper reuses the data that the authors themselves had originally used to discover and validate their variables, all the predictors had to do in the few years added was to not screw up. And the original results should still hold. So they're basically saying, look, we've only added a couple extra years, but if your data sets were so good, and their years you used, you shouldn't fall off that much. Don't screw up. Yet we find that the most variables have already lost their predictive ability. Of the 29 variables, 25 show lower in-sample significance when we extended a few years. Only 4 variables predicted about equally well or better. The widespread deterioration in predictive performance partly reflects the fact that the added years offered great variety. The added years of the Great Recessions of 2000s, 2008 and the 2020, and there were 2 major bear markets. These, perhaps in retrospect unusually remarkable episodes, could influence either an independent predictor variable or the dependent predicted equity premium enough to make a difference in the apparent forecasting ability, even though we had also included and thus recycled the author's samples to begin with. Our paper investigates not only whether variables had good and statistically significant in-sample and out-of-sample performance, but also the investment timing performance in some. Not a single variable meaningfully, much less statistically, beat the buy and hold equity investment. All equity all the time. Not a single variable beat buying the market. One can object that being invested in the stock market over the last 20 to 50 years was a remarkable positive experience and was tough to beat. But good all equity all the time was not the only reason. Half of the predictors performed so poorly that they not only failed to beat the all equity all the time, they even lost money. Our second investment strategy tilted far more towards equity. It was along the equity premium unless the predictor signal was extremely bearish, worse than the prevailing 25th percentile. 1/3 and 4th strategies also scaled the investment based on, so basically what they're saying is, at the end of the day, the only variable was to buy the market. That's it. Can't beat the market, so join it. The only prediction that's valid is to join the market. All the other stuff is just noise. It worked. The dogs of the Dow, the 3-factor model, we're evidence-based investing. Just buy the market and be done with it. But I can't beat the market if I buy the market. Yep, exactly. You can't beat the market, but you can beat your peers. All right. And the reason is because we know the market is just the aggregate of all investors that are out there. That's the market. Your peers are the aggregate of all the investors out there minus the fees they pay. So if you just buy the index, the total stock index, and be done with it, you're going to beat, you won't beat the market. You actually lose the market by the fees of your index, 5 basis points. Wow. but you'll beat your peers because your peers are paying a lot of fees in order to track the market and try to beat it. It doesn't make sense. And there's other stuff in this paper real quick. Here's the best strategy to beat the market. Fourth quarter growth rate and personal consumption expenditures, PCE, was introduced in 2015. High personal consumption growth rates this year predict poor stock market returns next. Empirically, since the 1970s, high growth rates in personal consumption has only made one modest misstep in its predictive ability, which was missing the Great Recession bear market. Otherwise, it's been a steady performer. Nevertheless, a risk-averse investor would not have been better off using this thing. And the point is, how are you going to follow? It just makes my head spin thinking about people who just have nothing but time on their hands to model this stuff and to try to beat the market. If you're so inclined, you want to read the paper, you can go and see what they say about each of the various models. I wouldn't waste my time, but you could if you want. It's in there. To the chase, as noted into the introduction, only one variable, which you already talked about, outperformed the all-equity, all-time investment strategy, i.e. the market. All right, come here. And it did with the simplest, naive, long, short market timing strategy, and it did so only by 0.2% a year. A few did better on equity tilted and or scaled investment strategies, yet none could beat all equity all the time in a statistically significant way. We absolutely do not want to imply that the authors of these papers we examined here made inappropriate choices. Our published research results have conveyed a distorted picture of reality, perhaps more obvious to participating producers and to outside consumers. Readers, referees, editors, and journals like papers with impressive results. Academic finance audience like impressive results, even more so if the results can be justified based on strong theoretics. Not surprisingly, motivated authors often obligingly offer them. Many of our papers seemed remarkably confident in expressing strong support of theory, regardless of whether these theories are neoclassical or behavioral. However, the presence of these theories seems not to have been offered to the desired solid and stable forward-looking performance that theory intended to provide. Yep. In addition to the problem that academic research gives the wrong impression that it's possible or easy to predict the stock market. There's a secondary problem of crowding out. Authors that write more mundane papers which fail to show remarkable powers are likely not to be published and thus disappear from the academic rat race. The incentives imposed by our collective on its members are clear. Yep. Many of the re-examined papers seem to defy common sense. The more aggressive models were promising unusually high timing rates of return to the readers, based on exploiting the ignorance or strange risk preference of ordinary investors. Yet easy profits forward-looking seems absurd to us. It's not been easy for a very long time, going back to Fama in 1970, to predict the equity premium or the performance of the large publicly traded stocks. Large U.S. stocks are traded in highly competitive markets, with even the smartest funds struggling to perform well. Yeah, you just stop. I mean, if you're looking for the new mousetrap, it ain't there. Stop. Buy and hold and be done with it. Keep cash, buy and hold, be done with it. Love your thoughts. We'll see you.